Theo, we're watching the JSE at the moment at an index level of about 50,000, just over 50,000. And that's at a level that was last seen about 4.5 years ago, and even kind of extending to 5 years ago. And South African investors are rightfully quite depressed about what's going on in the JSE and their investment prospects for their local shares. Are we in an environment now where they should just give up hope, or what should they be doing?
Yes, Warren, the last 5 years has certainly been disappointing. If you look at the three big drawdowns we've had, where the market really went down, we've had two of about 35-37% and one of 33% in the last 25 years. This 5 years has been worse than any of those two. Even if you invested the month before the market dropped in 2008 and 2002, or in the late 90s, you would have been better off after 5 years than you were the last 5 years. So it's been disappointing. The question now is, to what extent has this disappointment, this sideways movement in the market, to what extent has that brought value back into the market? Now, the key is on the South African market, because of the structure of the shares in our all-share index, you find there's quite a number of big companies whose price and whose business is not in South Africa. Naspers' price is made not in South Africa, in Hong Kong, and it is a derivative from Tencent's price. Richemont's price is made in Zurich. BHP Billiton, international mining company's price, is made in London. So therefore, you very quickly get to more than 50% of our market, not only whose business is not in South Africa, but whose prices are not here. That's the one side of the market. Then you have the South Africa Incorporated market. Those are the companies whose major business is in South Africa and whose price is determined by the Johannesburg Stock Exchange. Now, that portion of the market has become quite inexpensive. So that part of the market has actually become cheap. And there's certain stocks in that segment who's at lows that we haven't seen 10, 20, 30 years ago, if you look at their dividend yield or their price to book or their price earnings ratio. So our market has got two parts. It's the international side, which incidentally has become cheaper than it was a while ago, and then the local side, which has become very inexpensive. Now, what investors should be careful is, at some point there'll be a bit of a re-rating of these two sectors, and the opportunity is that the South Africa Incorporated side has been hammered down to levels where I believe these stocks are becoming quite good value. Will they go up? Well, that will determine on forecasted earnings and on a bit more confidence. But certainly, there's a major portion of our market that's at multi-decade lows from a valuation point of view.
Well, Theo, that's really interesting from a valuation perspective. Those companies, the more domestic South African businesses that you're talking about, if we look at their valuation, their price earnings ratio, and you say in a typical 5-year period, how would those kinds of companies perform when they're priced like they are now? They would generate a return of about 12 to 15% per year for that 5 years. Obviously, that doesn't mean that it'll come as a nice linear return, but certainly it's telling you that there is an opportunity set there. And we do quite a few surveys of fund managers and listen to a lot of their presentations around the country, and especially the different kinds of fund managers who do things in different ways. And what's interesting now is we're starting to hear them talk about the opportunities in the JSE, and for the last few years, all we've heard them talk about is invest overseas or invest in the South African bond market. So for me, that might not be an indicator to say now suddenly the time to buy, but it's certainly positive. And listening to what you're saying, it seems like a lot of the bad news about South Africa is currently in the price of the businesses that are listed here. And there is almost no good news priced into their share price. So if there is a marginally little bit of good news that we find somewhere in the markets in the months and years ahead, that will cause a re-rating of those companies, which is very positive for South African investors. So I guess in contrast to a lot of our messages that we've done in these newsletters in the past few months, it might be time to actually look at the JSE again with a bit more interest.
Warren, what for me is interesting, 18 months ago, 6 months ago, last few years, a lot of discussions was around politics and South Africa almost hitting a wall, and that we're in a dead end. We're going to hit the wall in a bad way. That politics discussion is moving away. It's moving again to economics, to policies, to investments, and I think that's a big change. We mustn't underestimate that. We're not seeing it in markets yet, but the discussions these days are not purely on politics and also not the negative side. It's all of a sudden on companies, company performance, investment principles, relative value, PE forecast, earnings forecast, and I think that's a great change from where we were 12, 18, 24 months ago.